Things are changing in this world, including the acts, the legislation as well. So as business people and business executives, we need to stay abreast of these changes. Recently, the assessed losses rules changed. Wait a minute, let's start by defining what is assessed loss. The term assessed loss is defined in Section 20, Paragraph 2 of Income Tax Act of South Africa. This refers to the tax loss that arise in the current year of assessment after deducting the admissible deduction per Section 11 from the income against which they are admissible. Sound technical, right? So in simple, it means the income less allowable business expenses. In this case, we have a loss. Hi, my name is Molen Mkuze. I'm the Managing Director of Brainmore Chartered Accountants. Today's topic, we're looking at the assessed loss. The assessed loss rules have always allowed companies to deduct from their taxable income each year any assessed loss from previous year. The remaining assessed loss balance could be carried forward indefinitely. The key word here is indefinite. This meant that a company would only pay tax once it made a taxable profit and all previous assessed loss had been deducted from the taxable income. For example, year 1, the company made a loss of 1.5 million. Year 2, it made a profit of 1.2 million. The company used to be allowed to deduct the 1.5 million from our 1.2 million, meaning it will not pay tax, but rather it will carry forward the remaining 300 to year 3. These rules have changed and may affect your next income tax bill. So stay tuned, hit the like button, subscribe to this channel, and comment and share to those who think will benefit from this. Let's look at what's new. Under the new rules, assessed loss brought forward from a previous year of assessment can only be offset against a maximum of 80% of the current year's taxable income, or 1 million, whichever is higher. This means that many companies will now pay income tax on up to 20% of the taxable income for that particular year if it exceeds 1 million. Even if the assessed loss balance carried forward from previous years far exceeds the taxable income. Looking at my example again, 1.5 million assessed loss from prior year. So this year we will say greater of 1 million or 80% of 1.2 million, which is 960. So the company will pay tax on 1.2 taxable less 1 million and pay tax on 200 and carry forward the 500,000 that it couldn't utilize to the next year. If you watch my video, I always say that everything has listen. To the CFOs, accountants, it's time to adjust your cash flow focus accordingly to cater for the tax on the 20%, though you may have assessed loss. Okay, what else should you know about these changes? Take note of the following. Number 1, the new rules applies to any year of assessment that began on 1 April 2022 onwards and that ends on or after 31 March 2023. Number 2, the new limitation, the 80%, applies to the company's assessed loss balance as at 1 April 2022 and not only to assessed loss accumulated after this date. So all assessed loss balance as at 1 April 2022 are subject to this law. Number 3, companies do not lose the balance of any assessed loss that could not be utilized in the tax year. It is just carried forward to the next year. From our example above, the 500,000 will be carried forward to the next year. Number 4, if a company does not trade for a full year of assessment and no income is earned from such a trade, the assessed loss balance will be lost completely. Tough luck, eh? Number 5, understand that there are some complex rules that may apply in certain circumstances regarding this. For example, the 3 out of 5 years rule and the ring fencing of losses if a business carries on one of the listed suspects' trade, which means you certainly need professional advice when trying to deduce an assessed loss against taxable income. Get hold of us or your tax practitioner to discuss this. as this will actually affect your tax bill as well. Other questions that you might have might be, who is affected? Will my tax bill be affected as well? Well, some companies will not be affected immediately. For example, companies that made losses during the year and therefore have no taxable income to reduce, they are not affected. Companies that do not have any assessed loss brought forward, they are not affected. And good news to the small companies with taxable income below 1 million is not affected by the new rules and can still deduct the full balance of an assessed loss against 100% of their taxable income. It's very important to note that this change will have cash flow implications for other companies. As illustrated in the examples that I previously shared, you would not have paid tax since you had 1.5 loss, but now due to the limitation, you need to pay tax on the 200,000. That's cash flow implication there. That is business needs to plan for. It is very important to note that both the new rules and the old rules have some complications in them. The wording in the legislation actually still needs to be certified. So speak to your accountant about the impact of the new rules and how that will affect your next tax bill. I'll actually share some illustrative examples on this channel so that at least you can see. Hope you have enjoyed the content of this video. If you did, just subscribe to this channel, hit that like button and hit the notification so that you don't miss out. Enjoy your day. See you in the next video. Bye.